In today's video, I'm going to talk about 4 different basic fundamental screens that you can use to start your own investment portfolio. I will be making a distinction between growth, valuation, quality and dividend, each with their specific ratios. The screening filters will ensure that with just a few clicks you will exclude a lot of stocks that are not worth investigating further. Because the first selection is made purely on the basis of objective and quantitative criteria, emotional decisions are avoided at this early stage. It is therefore important not to set the filters too strict at the beginning. You can always adjust them afterwards if necessary. Also keep in mind that most ratios are industry and sector specific. That means that the same value for a specific ratio may be low for one sector but relatively high for another one. Comparing ratios between companies from different sectors or industries is like comparing apples to oranges. So without further ado, let's get started. My name is Christoph. Welcome to ChartMill. So let's start with a basic screen for growth stocks. These are primarily companies that are still in their growth phase and where a large portion of earnings are used to fuel growth even further. On the home page, select the stock screener page from the main menu on the left. The available ratios were recently organized by category. So for the growth parameters, we will mainly use the filters you can find under the tab Growth. Why I use exactly these ratios and some more detailed information about the differences between growth, value, quality and dividend stocks can be read in this blog article. And I will add a link in the description at the bottom of this video. So for the screening, earnings per share growth 1 year bigger or equal to 15%. The earnings per share growth quarter to quarter 30%. Earnings per share growth next year bigger or equal to 15%. Revenue growth 1 year 20%. And the revenue growth 3 years 15%. Finally, revenue growth next year bigger or equal to 25%. Then select the Health tab, and for the debt equity select smaller or equal to 1.6. Then go to the Profitability tab, and for the return on equity select bigger than or equal to 10%. Next, in the horizontal blue bar, click the inverted triangle next to View and select Columns and then Fundamental Growth. This view is specifically designed for viewing growth stocks individually and investigating them further. If you like to compare companies, a table view might be more convenient, and to do so, change the view to Tables and then Fundamental Table. You can of course design your own custom view, for example this one I designed myself specifically for growth stocks where I focus on revenue and earnings per share. And how to create custom views can be seen in the video that now appears in the upper right corner. As I mentioned in the beginning of this video, you may only compare these ratios between companies belonging to the same sector or industry. That's why I always withhold the sector data when I create my own table view. For example, if you want to compare only the companies that are part of the information technology sector, go to the General tab and open the drop-down menu under Sector. There, select Information Technology. Now you can compare stocks belonging to the same sector. For example, if I click on the column Revenue Growth 3 years, the results are arranged in descending order based on this parameter. If you prefer to see the results in ascending order, click again, and you can do the same with all the other columns. With the following filter settings, I instruct ChartMill to look for value stocks. These are stocks whose price are lower than the intrinsic value. However, the company must still generate sufficient sales and profit. After all, not everything that is cheap is therefore automatically worth buying. A value investor is an investor who seeks stocks that are undervalued based on his or her insights. And I use the following parameters under the Valuation tab. Price earnings lower or equal to 10. The forward price earnings lower or equal to 12. Price book ratio lower or equal to 1. The price earnings growth for the next year lower or equal to 1. And the price to free cash flow ratio lower or equal to 10. And I refer again to the blog article and to our general documentation section if you would like to learn more about these ratios and why they are used for this value screen. Where possible, I will add a link to specific articles below. Just as we did for growth stocks, we select a specific view to further analyze value stocks. This is again done via the drop-down menu in the blue horizontal bar next to View. And once again select Columns, but now choose FA Valuation. This view focuses on ratios of particular interest to value investors. Quality investing has gained much popularity in recent years. This strategy looks for businesses with a good reputation, stable and rising capital returns, and a solid balance sheet, being not too much debt. These companies show decent, balanced growth, and because these companies have a solid market position, usually accompanied by a pronounced moat, the likelihood of stiff competition is relatively low. The major difference with the value investor is that the quality investor is willing to pay a premium, albeit not excessive, on top of the intrinsic value. So first select the Growth tab and choose the revenue growth. The 5-year compound annual growth rate has to be bigger than 5%. Same for the EBIT growth, bigger than 5%. And EBIT is the operating profit before interest and tax, but all the operating costs such as wages, rent, marketing costs, depreciation and amortization are taken into account. We also want that the EBIT growth is bigger than the revenue growth, because this is an indication of improved profitability and pricing power. Such a filter is not available by default in ChartMill, but fortunately we can easily solve this with a custom filter. So select the Custom tab, and for the left hand side select Property, Fundamental Growth, and then EBIT growth 5-year. For the equation itself select Bigger Than, and then for the right hand side again select Property, Fundamental Growth, and then Revenue growth 5-year. Now press Add Filter. In the top right corner you will see that the custom filter was added. And by the way, you can still change the settings by clicking on the icon next to this custom filter. The next filter is the most important ratio for finding quality stocks. It is the return on invested capital. In ChartMill we have several versions available in the platform, and this article tells you more about it. A link can be found below. So select the Profitability tab and choose Return on Invested Capital, excluding goodwill and cash, bigger than 15%. This version, where both cash, goodwill and intangibles are extracted from invested capital, is the most operational way to calculate return on invested capital. It tells you what return the company achieves on its working capital and net property, plant and equipment. And finally, select the Health tab and change the debt to free cash flow lower than 5. This ratio shows how many years it will take to repay all outstanding debts with the current free cash flow. 0 to 5 years is a good acceptable ratio for quality companies. A higher figure indicates some danger and ensures that you will have to dig further into the numbers to find out what the exact cause is. Dividend stocks are stocks of companies that pay attractive dividends year after year, and most companies that pay such dividends have stable sales and profits. Because the companies are usually already fairly mature, there is very limited investment in further growth, and that leaves much of the profit to be paid out as dividends to shareholders. So choose the Dividend tab and select the following filters. The dividend yield has to be bigger or equal to 3%. So a decent dividend yield is important, but don't be trapped by very high yields. While that may look very enticing, ask yourself how it is possible. After all, the dividend yield is calculated on the stock price, and a sudden sharp drop in the share price has the effect of increasing the dividend yield. So always consider what caused the stock price to fall. If the company is in bad papers, chances are that a high yield cannot be sustained. Payout ratio smaller than or equal to 80%. This ratio shows how much of the net income is used to pay dividends. If the payout ratio is only 30%, enough capital still remains for other investments. This is much less the case with payout ratios higher than, say, 70 or even 80%. The level of the payout ratio also depends on the company itself. Very large established firms that barely focus on further growth have a greater margin to use a significant portion of their net income for dividend payments. Dividend growth 5 years bigger than or equal to 5%. So stable dividend growth is usually a sign that the company is performing strongly. However, the same warning applies as with dividend yield. Don't be seduced by spectacular dividend growth outright. and dividend non-decrease years bigger than or equal to 5. Dividend investing is meant for the long term, and this involves keeping companies that pay solid dividends in port for as long as possible. And companies that manage to increase or not decrease their dividends year after year are ideal in this regard. Be sure to select our specific dividend view to compare the results. A few things to consider as well. Take into account the general market conditions and the related market sentiment. Identifying companies that do quote cheap based on your research can still lose much of their value if the general market sentiment is negative. What sectors do your selected companies belong to? Are these rather defensive or cyclical sectors, and what about the short, medium and long-term performance of that sector? It may well be that you spot a great stock that stands out because of recent results, but if that stock is part of a sector that is underperforming, any lesser results of the sector peers will also have a negative impact on your carefully selected company. Are there several candidates in your selection that belong to the same sector? Great, that makes it much more likely that the sector in general is also doing well. Don't forget to compare those companies with each other, since many of the ratios used above are sector specific. And don't just base yourself on the results of a specific ratio, but also look at its historical evolution whenever possible. It will give you a better understanding of the sustainability and the robustness of the company itself. Finally, in addition to the listed quantitative parameters, there are numerous qualitative characteristics that make companies with seemingly the same quantitative results yet very different. What about the quality of management, for example? How does the company compare to its industry peers? And how strong is its competitive position? To what extent does the company have further growth potential? Can it respond to new or changing trends in a timely manner? Is the company able to pass on rising costs without much difficulty if necessary? And is the company sufficiently resilient if economic conditions deteriorate? Investing in stocks takes time, patience and perseverance. Which strategy you use in doing so is different for everyone, but always make sure it matches your personality and risk appetite. An attractive return is important, but not at the expense of your mental well-being. If you found this video valuable and you are likewise concerned about our mental well-being, please like this video and subscribe to our channel. Thanks.